Welcome back to Surviving Retirement. My name is Peter Guidori, Chartered Accountant, Certified Financial Planner, and Senior Wealth Manager. Last year, we discussed the impact of a second Donald Trump presidency. In 2025, equity markets held up well, with major indexes posting strong gains and small caps staging a notable rebound during the year. The Canadian dollar, after falling below 70 cents early on, recovered toward 73 cents by year-end. This year was also marked by significant political and social events, including Liberation Day, which shaped sentiment and policy discussions. Now, as we look ahead to 2026, our outlook focuses on several key themes: global factors behind a weaker US dollar and the implications for the Canadian dollar. What is the current enthusiasm for AI and whether it represents a bubble? We're thrilled to welcome back Martin Roberge. Martin Roberge has served as a managing director and North American portfolio strategist at CG since 2011. With over 30 years of experience in the securities industry, Martin and his team are responsible for providing tactical asset mix and sector rotation research and recommendations to the firm's investment advisors. He is regularly ranked among the top gun analysts in portfolio strategy, according to Brendan Wood's international survey. Congrats. It's great.
Thanks.
So Martin, welcome, and thank you for joining us today.
Thanks for having me.
What global factors are driving your forecast for a weaker US dollar in 2026?
Yeah, so as we know, we learned from the Bank of Canada last week that they're going to pause for a little while. They've taken their policy rates down to about 2.25%, if I remember, and that's about in line with inflation in Canada. But in the US, as we know, Fed funds are much higher at around 3.75, with underlying inflation like probably low twos. So the Fed is probably going to continue cutting interest rates to get that policy rate in line with inflation, because right now it is still a little bit too restrictive when we consider that the labor market is still slowing as we're seeing. So bottom line is that the rest, like Canada, will pause while the US will keep on cutting rates. So in relative terms, it will put more pressure on the US dollar relative to the Canadian dollar.
So we're looking at Canadian dollars target a little bit higher?
Yeah, we look at the CAD USD around 76 cents by the end of 2026.
Okay. The other theme that seems to be taking a lot of attention also is AI. And last year, this time, as you know, when we were talking, Donald Trump was about to come into office, and there was a lot of questions as to where 2026 was going. Now, with the benefit of hindsight, a lot of discussions regarding AI and a potential bubble that we're in the market. What are your thoughts about that?
Yeah, we are probably in a bubble, but the thing with a bubble is we just don't know when it's going to pop and how big it is going to get. But to the extent that folks are looking at the 2000.com episode as a guide, we're certainly not there with AI-related stocks. One key difference is that those companies are funding their CapEx with their cash flow. Okay?
Unlike 2000.
When it was mostly with debt.
Right.
Okay, that's number one. Number two, they generate a lot of cash flow, which they're using to finance most of their CapEx, but they're not like overspending. They're not burning cash. The model or the business model, way more solid than in 2000. And lastly, which is probably the most important factor, for a bubble to pop, you normally need a tighter monetary policy, higher increasing interest rates, putting pressure on valuation, putting pressure on the business cycle. We have the opposite right now. We've got the Federal Reserve easing, the government also spending and about to do a little bit more in 2026 with a big, beautiful bill. So it's really rare for valuations to pop or to compress when the government and the central banks are easing, not only in the U.S., but around the world as well.
Just so they're kind of, adding fuel to it in the sense.
Yeah, they're adding to the punch bowl.
Right, okay. Is there a catalyst, do you think, that, as we talk about potential things that could go wrong that would pop this bubble?
If companies were to overspend, increasing their level of debt, because right now, if you take the hyperscaler, the big tech companies, they sit on about 400 billions of cash on their balance sheet. And this is acting as a backstop for debt holders. So they can issue a little bit more debt. But if they start to burn that cash, well, people will eventually ask question, will they need to take on more debt to finance the CapEx cycle? But so we're just watching companies, how they're spending, and made sure that they spend in line with the level of cash flows that they're generating. And right now, this is how they're doing it.
So they're within range.
They are within the range of what we normally see through a CapEx cycle.
Understood. Okay. No, that's very helpful. And talking about cycles, what are some of the contrarian economic cycles that you see or themes for 2026?
Well, it's going to be a bifurcated economy. On one hand, we're seeing the housing market and the labor market slowing. But on the other hand, you've got the AI spending cycle, which is going to continue over the course of 2026. And also, consumers enjoy pretty good disposable income and obviously benefiting from some wealth effect from the strong performance of financial markets. So what we're likely to experiment in the first half of the year is the continued slowing in growth. And this is the lagged impact of the tariffs. This year, we had a little punch in April. We had companies overstocking goods in case that the tariffs would be too punitive. Now they are, as we say, unwinding or working off this excess inventory. And it takes time. So it's going to be probably completed by this summer. And then we're going to start to see another restocking cycle in the second half of the year. This is something that we'll have to monitor because we could have demand-led inflation once again. Like 2022 was more supply-driven inflation. 2027 could be more demand-driven inflation.
Are you seeing that perhaps, as we back in, if I understand correctly, into the second half of next year, that as they start to restock inventory levels again, it might be at higher prices because it sounds like tariffs are here to stay, at least for now. But that would be mitigated somewhat by monetary policy as well. So, but is consumer demand still healthy? Is it still strong?
Well, we've got this, what we call the K-shaped economy, where you've got 40% of households accounting for 2/3 of total consumption. So obviously, middle class is being hurt by not only high interest rates, but slowing jobs creation. We're going to continue to see this bifurcation until probably we get the end of this global manufacturing cycle. Like we've been into a global manufacturing recession for 3 years now. But if I'm right, that the impact of monetary and fiscal stimulus should take the global economic recession, shift it into a higher gear in late 2026, 2027, and boost the jobs market again. And manufacturing jobs are normally, as we know, into a tranche of that population where wages are not as strong, or disposable income is not obviously the highest. So this what we call the blue collar side of the economy should resurrect probably in the second half of 2026 and then do better in 2027.
So kind of soften the blow as we're going.
Exactly.
Understood. Okay. We were talking about labor and housing markets. So it sounds like, and we're seeing that a little bit in Canada, I'm not sure it's the same in the States, but that housing sales are have slowed down a bit. Do you expect that to pick up?
In the US, yes. And the reason is affordability. It's not so much well, obviously, we have a wide margin between mortgage rates and interest rates, like the level of bond yields, which is something we don't have in Canada. So the rates are hurting in the US, but also prices. Affordability is so poor that even if you were to see a 2% decline in bond yields, your average affordability would get back to the historical average, which is something that is required to get the housing market going again. But until we get there, we need a significant decline in bond yields and mortgage rates. In Canada, we don't have the same situation because the yields are tracking the Bank of Canada rates. And as we discussed earlier, those rates are much lower. So we have probably a market more in equilibrium. There are some pockets, obviously,
Right.
like Toronto, Vancouver,
Toronto, yeah.
but across Canada, we still believe that the housing market is healthy overall in Canada, while still under pressure in the US.
When you're looking ahead next year, when we're looking at perhaps targets on the S&P 500 or TSX, are you seeing the same type of returns? Because this time last year we weren't sure what to expect. We've had a year now with Donald Trump in the White House, and hopefully a little bit better visibility on the policies. What impact, or how does that affect your forecast now that we've got a little bit more time under the belt?
Yeah, the prospects for the index itself, whether we talk about the TSX or the S&P 500, like we're gonna probably match the earnings growth, which should be pretty good, like around 10-15% if we're right on our economic outlook, looking for a good recovery in the back half. The things are, the way we play the market could be different. As you know, this year, a lot of the returns are coming from, in Canada, well, obviously precious metals, and materials. In the US, it's the AI-related stocks. Next year, it could be the opposite, where we have a broadening of the market, more participation from other sectors. Just to give you some numbers, since the April low, like Liberation Day, AI stocks are up about 60%. The S&P is up about 30%, and the non-tech stocks are up only 20%. We could see a reversal of that performance ranking in 2026, with the rest, or what we call the non-tech stocks, providing the leadership. And this is in line with the fact that those stocks are usually more cyclical. If they are more cyclical, they need rate cuts. They need a weak US dollar, weak Canadian dollar. So we've got those ingredients right now. We've got enough backstops for investors to embrace more risks outside of technology, because we've got visibility on growth. When there's no visibility on growth, people tend to hug the growth stocks because they don't need the business cycle to thrive. But when the business cycle is improving, you move away from visibility, or you go from low risk to higher risk. And this is where we find mostly international stocks, what we call cyclical stocks. Those areas that have lagged this year should probably do much better in 2026.
In terms of relative valuations, looking across the world, what are you seeing?
Yeah, the valuations are obviously less demanding outside the US, and this is the opportunity. Those companies in those markets are globally geared, like they do business around the world. So when you look at the earnings growth, margins, they match most of the attributes of US companies. But because in the US you've got this AI cycle, those US value stocks have done some piggybacking on AI stocks, while the rest of the world, are moving on their own, moving with their their sales outlook, their earnings outlook. And what we see is that valuations are often 20 to 25% cheaper outside the US. And if on top of that we're right and the US dollar continues to move lower, we're going to also experiment what we call a currency gain. So international stocks, whether we talk about earnings growth or valuations, provide a better risk-return ratio in our view.
It sounds like that's an area we've heard with other
another year. Like we had a good year this year, but that's year number one. We believe we're going to have another good year for international equities, including also Canadian equities. But instead of goals, it could be the other sectors.
Right, that have been laggards.
Yeah, industrials or energy probably. Those sectors have not done a whole lot. But they could be a good companies, good stocks in 2026.
Terrific. Well, thank you, Martin, so much for your time. We appreciate your expertise and your insights as always, and thank you for sharing it with our viewers. And to all of you out there, thank you for joining us. We wish you well for the new year, and of course, be kind to yourself and to others, and we'll see you in 2026.